The number of Canadians who find it very difficult to pay their mortgage has doubled since March. Now, if you're a homeowner or plan to be one, this is crucial information you may want to pay attention to. Stick around till the end where I also talk about what Canadians are doing to possibly overcome this. Hello everyone and welcome back to my channel. My name is Sid Sur from Sid Sur Real Estate. I help clients with buying, selling, leasing, investing, as well as first access to pre-construction condos. If you're new to this channel, please consider subscribing for all things real estate. To book a one-on-one, no obligation call with me, click the link in the description. That'll take you to my calendar page where you can book a date and time that works best for you. So there's a new report that says the number of Canadians who find it quote-unquote very difficult to pay their mortgage has doubled since March. So since March, the Bank of Canada has raised their key interest rates twice, and as a result, homeowners are struggling to pay their mortgage, and that amount has actually doubled. Now, this report is by the Angus Reid Institute, and it says that 15% of mortgage holders now find the financial aspect of their living situation quote-unquote very difficult, compared to just 8% in March. Additionally, 30% describe meeting their financial commitments as tough. However, it's not all bad news. Encouragingly, 47% of respondents find their monthly mortgage payments manageable, although this number has also fallen 51% from March. Now, this survey was conducted in early October with responses from 1,878 Canadian adults. So let's delve into the reasons behind these changes. The Bank of Canada has raised interest rates significantly. Between 2018 and 2020, the policy rate changed between 1 and 2%. Now, following the onset of the pandemic, rates were cut to 0.25% with promises of keeping them low for a long time. However, in March of 2022, the bank began rapidly raising rates, which currently sit at 5%. Now, here's a chart representing Bank of Canada's overnight interest rate and also the inflation rate at the same time. And as you can see in this chart, on the onset of the pandemic, when rates were super low because the government was trying to encourage spending because everybody was locked in at homes, inflation really started spiking upwards into 2021 and really spiked in 2022 summer, where it was around that 8.2% mark. And starting in 2022, March, the bank aggressively started raising their rates. And of course, with the recent Bank of Canada's announcement that happened yesterday, where they decided to hold the key interest rate, it'll be interesting to see what type of impact that has on the market. Now, here's where it gets interesting. The most common mortgage term in Canada is 5 years. So homeowners who are locked in at low rates are now facing the prospect of renewal. Based on this report, half of Canadians with a year or less left on their mortgage term are already struggling financially. In fact, 59% of these homeowners find their monthly mortgage payments difficult to manage, and 57% are quote-unquote very worried that their payments will cost significantly more upon renewal. For those with 1 to 2 years left on their mortgage term, 48% are very worried about renewal, and 46% find it tough or very difficult to make their payments every month. Now, it's not just about interest rates and mortgage renewals. Household debt is also a significant source of anxiety for mortgage holders. 65% of all respondents said their household debt level was a source of stress, but this figure rises to 81% among those with a mortgage. To add to the stress, 49% of Canadians feel they are worse off financially today than they were a year ago, and 35% believe they will be in an even worse situation a year from now. Now, these figures tie record highs seen over 13 years of the Angus Reid data that we're looking at. Now, Wealth Rocket did a similar survey where they asked Canadians how they're covering housing costs. For 36% of Canadian mortgage holders, one partner's income is eaten up by the mortgage payment, while the other person's income covers all of the remaining household costs, like utilities, property tax, or condo fees. For slightly more than one quarter, or 27% of respondents, one partner's monthly income covers all of the housing costs, including the mortgage. Now, this chart represents the percentage of Canadians who are spending more than the CMHC's suggested ratio of income towards housing. Now, according to CMHC, your gross debt service ratio, or your percentage of your income that goes towards housing costs, should not exceed 39%. But as we can see in this chart, the percentage of monthly income Canadian mortgage holders are putting toward their housing costs, about 1 in 3 or 31% are spending above the CMHC ratio on housing costs. When we look at the provincial breakdown, Ontario takes the lead at 38%, whereas the western provinces of Alberta, Saskatchewan, BC, and Manitoba are at 28%. Now, the Bank of Canada is set to make its next key interest rate policy decision on December 6th. 35% of Canadian mortgage holders say that one interest rate hike or more from the Bank of Canada, either this year or in 2024, would make it necessary to make a significant change to their current situation. Now, that might include altering their mortgage agreement, living arrangement, employment, or lifestyle. As you can see in this chart, 17% say they would get an additional job, 16% would need to extend their amortization, 9% would need to sell their home, 7% would have to break their mortgage, and 4% would have to rent out all or a portion of their home. Now, these surveys highlight the financial challenges Canadians are currently facing, especially when it comes to paying their mortgages. With rising interest rates and the prospect of mortgage renewals, it's a situation that demands careful financial planning and consideration. One of the things you can do as a mortgage holder is talk to your lender or mortgage broker to see what impact the rate would have if there were to be further rate hikes and whether or not you would be able to make those payments. And be proactive to see how, in the event rates do go up and your monthly mortgage does go up, but your household income may not be enough to cover, you may start to be proactive in finding alternative ways to come up with those additional funds. That's it for today's video, guys. If you guys found it helpful, please go ahead and give it a thumbs up. And of course, if you're new, don't forget to subscribe. Thanks for watching. Take care.